Hello, welcome to the January 2018 edition of Tax Talk. My name's Anita Monteith, and with me today I have Jane Moore, who's editor of TaxLine.
Hello.
And Ian Young, who's our international tax manager.
Hello.
Well, thank you for dropping into the UK, Ian, because I know there's an awful lot going on at the OECD at the moment. There's actually quite a lot going on everywhere at the moment, and as we speak, I think the Finance Bill 2017-18, as it's colloquially known by HMRC, is entering its committee stage.
Yes, this week. Yeah.
We've made a number of representations. We've got obviously something on non-resident trusts, which I know has got people very upset.
Yes.
Disguised remuneration, ditto. We've put in something hybrid, mismatches in.
Yep.
And partnerships, where I know a lot of our business committees have been upset by some of the proposals. So we've made the comments. It remains to be seen
whether anybody reads them. Yeah.
Well, exactly. Now that will, we hope, turn into the first and only Finance Act of 2018. Please don't let us have another
Sometime
year.
in March.
Sometime in March. We don't want another year like last year, though, do we?
No.
We've got quite a lot of consultations on the boil at the moment. We've got quite a lot about how we tax the digital economy, and Ian, we're going to be talking about some of those proposals during today's Tax Talk. Jane, there's mandatory disclosure and more on the common reporting standards now that we want to pick up on. I'm going to pick up a little bit on MTD and VAT digital records.
No Tax Talk complete without MTD.
No, I know, but mostly what I want to say is that Sarah Ghaffari and I are going to give this a really good going over. Next week we're going to do a whole webinar on it, so any ICAEW members who would like to sign in for that, that's on Tuesday. Other things that are happening, there is a renter room relief consultation, and I know that Sue Moore would very much like people's responses, their views on renter room relief and how it's going. That's a call for evidence. So if you are interested in that, if you have clients who use the relief, please do look at that consultation, which you'll find on gov.uk, and email your comments. I suggest you use the general email, which is taxfac, TAXFAC, at ICAEW.com to get in touch with Sue.
Or indeed on any of the other consultations.
Yeah, and for you, Jane, it's going to be the MTD late interest interest one, isn't it?
To that one, yes.
We'll talk about a little bit later. Okay, so let's just talk a little bit then about the Brexit proposals that are going through at the moment. Now, Ian, we've been looking at that. We know we've had the customs bill recently, but working backwards from the departure date, we know that the gun will go on the 29th of March 2019 when we actually do our Brexit. We've got a lot of negotiation to do, haven't we?
We have indeed. So we're almost halfway through. So we triggered Article 50 on the 29th of March last year, and now we're, as I say, almost halfway through, and we haven't got very far, I have to say. So we've basically agreed the severance arrangement, so the exit charge, although we're never going to quantify how much we're actually going to pay. And we've also sorted out the status of EU nationals in the UK and UK nationals in the rest of the European Union. And we fudged the Irish question, so that's really waiting to blow up, I suspect. Sometime.
That's a really big deal, isn't it?
So that's a really tricky issue, and we've got
also
we've got the DUP who are supporting the British government keeping in power. So they have firm views on what they think the outcome ought to be. So that's going to be really difficult, and we're just about to begin, and the Chancellor and the Brexit Minister are in Germany at this very moment as we speak. Talking about deals with Germany, and the European Union countries have remained pretty on the same page in terms of negotiations. I suspect when we start as we're now doing talk about trade, they will all have their own particular sort of requirements, and it will get much more sort of many-voiced And we really won't have, I suspect in the next 3 months we'll get a clearer idea as to what sort of deal is possibly going to be negotiated. But even so, the deal isn't done until the deal's done, and traditionally the European Union gets to its real negotiating sort of bright lines when they have the pen out ready to sign the final document. So we won't really know till March next year.
But the UK was actually trying initially, I think what we said was that we were hoping for an agreement to be in place by the 29th of March 19. The EU always said that we actually weren't going to be able to conclude on an agreement until after that, when we became a third party state.
I think it's very unclear what the process is actually going to be, because Article 50 is very short. Nobody thought that a country would be leaving the European Union. They didn't give much thought to it. We're now working it out as we go along.
So,
and the two sides have different views as to what the appropriate thing to do. So, yes, technically, we don't start negotiating the trade deal until we've actually finished the Article 50 process. Well, that doesn't make an awful lot of sense. That's a cliff edge like no other cliff edge I've ever seen.
So it seems to me that the period of transition, which is going to start after March 19, we are still going to be negotiating.
Yeah.
And that is going to probably cost us a little bit more money. But at that point, though, there are going to be two categories of outcome, aren't there? We're either going to be a trade relationship based on world trade, WTO rules, or we are going to continue with the status quo. And I know that a lot of trade associations recently, car manufacturers and so on, have actually written to the government saying what we need is a transitional period, which is the same as status quo, really.
Well, it's difficult to see it, for me, it's difficult to see that you can't have anything other than that transitional arrangement where you preserve what is currently in place, and you then determine over the transitional period what is going to be the new outcome at the end of that transition.
Yeah.
So, but I think the problem for individual businesses and industries is that if they're going to have to need some sort of toehold in Europe in order to continue trading with Europe, they're going to need to start doing that sooner rather than later. So basically by the end of March, quite a lot of industries will have to make their mind up as to what they need to do to preserve the benefits they've currently got under existing trading arrangements. And the financial institutions even more so, because if you want to set up a new bank somewhere, it takes you a couple of years, so you're too late already.
I've been looking at some of the VAT consequences under the two extremes, and I haven't quite appreciated the extent of the cash flow implications for if we suddenly came out of the EU and had to use rest of world rules, and they are quite serious. And there is actually a crossover between Brexit, what will happen afterwards, VAT, and making tax digital. I'm pleased to say. And I've been doing some worked examples that won't work, I don't think, just here now. But I'm quite
do them next week, though.
Yeah, do them next week on the webinar. I think we could have fun looking to explain what those problems are. Okay, so all to play for.
I think the other point to make to viewers is that we have control over our UK tax system and always have done. So we haven't integrated an awful lot of sort of, if you like, European Union tax rules in the UK, except in the customs front and on the VAT front. So direct tax is something for us to deal with. And with the exception of a few treaties which the EU directive are more favourable than the bilateral treaties. So if you have a subsidiary in Germany, you'll suffer a withholding tax on the dividends you pay back to the UK unless we change the existing treaty, and the same is true of Italy. So there will be a few sort of minor tweaks needed to the fallback bilateral treaties, but in the main it doesn't make that much difference in that front.
Okay. In the meantime, we have got a tax guide on the tax implications of Brexit, which is Tax Guide 2117 that we published right at the end of last year, and that's available to download from the ICAEW.com website. There's quite a lot going on in tax line as well at the moment, isn't there, Jane?
Yes, well, we've been doing articles on the various finance acts and bills. There's a summary of the Second Finance Act 2017 in January's tax line, which is on the website now and is arriving in hard copy shortly. I've got a summary of the finance bill actually going into the February issue.
Right.
And other things that we've been looking at, a detailed article about the offshore trust changes in the current finance bill, and we also covered the non-dom changes in a previous issue, December I think it was. An update on the trust register, which more are non, it's a bit of a moving target.
Right.
And articles on things like tax and human rights. Got an article on that in February, and indeed Ian wrote about similar matter in international charters a couple of months ago, I think.
Okay.
Yeah.
So if you haven't renewed your membership of the tax faculty yet, please do. Keeps us busy.
Yes.
Keeps Jane employed, especially
Yes, that's
writing
very
tax
important,
lines.
yes.
Very important. Right. January.
Oh, that's
31st of
down from the
January. All
rarefied
sorts
atmosphere
of
of
things. Exactly.
Brexit.
Let's get back to the UK.
Yes.
Jane, do you want to start with paying HMRC?
Start with paying, yes, and this
Pay
is
your tax.
Yes, so this is the date here is not 31st but 13th of January first of all.
Why is it the 30th
Why is it
of
the
January?
Because from after this Friday, you will no longer be able to pay HMRC using a personal credit card because the revenue are not going to be allowed to pass on the fee for using personal credit cards to the customer anymore, and they've decided that it's not fair to the greater body of taxpayers, so they're not going to do that. It follows an EU directive, so it's not just HMRC, it's everybody. So this is aimed also at Ryanair and other culprits who like to slap large fees onto
Extra
people.
charges.
Yes.
Yes.
So they will have to decide what to do. One would guess prices might go up somewhere,
Mm.
but government departments, of course, have to consider whether it's fair to bear the cost of a fee just because somebody has decided to pay by credit card.
So if you want to do it, you've got to pay by credit card before Friday.
On Friday, because it changes on the 13th, which is Saturday.
Okay.
But you can still use corporate credit cards. It's personal credit cards specifically.
Isn't there a charge on corporate?
Yes, but you can still use them
Okay.
because you're allowed to pass that on. You see.
Different
Whereas-
rules.
Yes.
Oh, interesting.
This is just for consumer protection.
Okay. Actually, I've got something on paying HMRC too, which I think is probably it's less than mechanics as knowing how much you've got to pay.
Ah.
And it's a bug that's really annoyed me for years.
Here we go.
I know. But when you go on the HMRC, you look at your individual account page. I was doing it with my son last night, who I'm teaching to do his own tax. And I said, will you tell me how much you've got to pay? And he said, well, it's that number there. And I said, no, it isn't. If you click on it, you'll find it ignores your payments on account. And in fact, he had nothing to pay.
Yes.
But his first gambit was to suggest that he had to pay what the words say, the amount due for payment on 31st of January 2018.
Yes,
So
that's not clear.
no, it isn't clear, and it really annoys me. There we go.
Right, okay.
That's my personal
There are
thing.
other ways to pay, such as online. Obviously, the revenue prefer you to use that for security reasons. You can't pay at the post office anymore. That's ceased on the 15th December.
Right.
But you can send a cheque in the post if you can find a payslip to do that with.
Right. Okay. So no excuse for not paying your tax then if you try hard enough.
I mean, it's a moot point whether paying with credit card is a good thing, and of course for those who are maybe in hardship and struggling, money on your credit card is perhaps not ideal. You can instead go to the revenue and get a time to pay arrangement set up and pay by instalments, and that's the better advice really.
Well, also it does give you extended credit. You know, if you've got some money that is definitely coming in.
Yes.
It gives you another few weeks.
It does have that advantage, yes, but if you overpay, of course the repayment goes back to the same credit card.
True.
Which is something to be thought of as well. So credit cards not always ideal. Great for some clients, not for others.
Well, of course, before you actually get to pay your tax, you do have to make sure you've got the tax return in. And some people will
or at least
still
you
be-
know how to pay. You don't have to get the return in. You just need
Oh,
to know
okay,
what
you
the
know
bill
what to
is.
pay. That was my link to the next point on our list.
Sorry, I'll show something.
Which is
Do continue.
self-assessment
Yes.
exclusions.
Yes.
It's been around for years.
Yes, but there are more of them now because there are some people who are either are not able to file online for various reasons. Security reasons is one, but also because with the many and varied exciting rates and allowances we now have for savings, dividends and so on, the software cannot guarantee to get the right answer if you file online and it goes into the tax calculation. So there is a list of exclusions of people who can file on paper if that's likely to be a problem for them.
Yeah, and this is just something that's going to get worse and worse if we continue to extend the number of reliefs in the tax system that affects tax calculation.
Yes, I mean it is annoying. I have a certain sympathy for HMRC in that they're not creating these different reliefs and allowances and cut-offs. So.
But it's going to be very difficult to get rid of them now, isn't it? You give people a relief and then you say, I'm sorry, it's too difficult to program this, so we'll take it away again just so we can get the tax right.
Simplification, Jim, but not as we know it.
Right. Well, I think that is going to be one that's going to keep going for a while, as has the trust registration.
Oh, the trust registration service, yes. I'm sure people who are agents will know that the trust registration service has to be used to register trusts. New trusts had to be registered by the 5th of January.
So you could get a UTR.
Yeah. So you could get new trusts, to be strictly accurate, trusts that had a liability for the first time in 2016-17. Originally it was the 5th of October deadline, that was extended. Existing trusts, i.e. those who are already registered for self-assessment, still have to be registered on the new service online by the 31st of January, which is not far away. There have been many problems with the service, and the Revenue have said, without extending the deadline, that a grace period without penalties being charged will apply up to and including 5th of March. Because we don't know what the penalties are yet, so that's an extra element of cliffhanger, really.
Well, I guess that gives them a bit longer to get the penalty system.
But we've done a lot on this on our newswire, and the worry is that people who are trustees but not generally working in tax may not even know that this new system is out there.
And am I right in thinking that the Q's and A's that HMRC have published are only available through ICAEW's website or other professional bodies' websites?
Much of it is, yes. They've not really done the Revenue, done much publicity at all on this.
I suppose no budget, nowhere publicising.
No, and unfortunately I imagine that ignorance would be no reasonable excuse.
Although there was that recently for non-resident property owners, capital gains tax.
Yes.
They've backed off chasing them.
Yeah, there have been two cases at the end of December though, where the tribunal thought it actually was fair enough and they should have known.
Oh,
so you take your pick really, in which case you want to rely on.
Okay.
I think they're all first tier, so none of them's precedent.
So it's not that straightforward after all.
Of course it isn't.
Do you want to mention tax credit renewals?
Yes. 31st of January is the last date to finalise your 2016-17 claim for tax credits. That's working tax credit and child tax credit, or to renew for the current year 27-18. You should have done something at 31st July. If you used estimated figures to renew at 31st of July last year, you will need to finalise those by the end of January, but you should still stay in the system. If you didn't renew and you fell out of the system, you may be able to stay in if you can show what went wrong and ask the Revenue to renew. Otherwise you have to reapply.
Right, start all over again. Okay. Now actually I'm sorry, we're going to stay with you next because we have a consultation that we've been working on, which is in line with the changes for making tax digital, but it's the new interest and penalties consultation.
Yes, there have been two strands for this. One is penalties for late submission of an MTD return or tax return, and there's not a consultation at the moment, but there was a document the Revenue published on 1st December explaining what they plan to do next. There is an open consultation on interest on late pay tax and penalties.
So these are two different things, aren't they?
They are two different things. As there is at the moment, there'll be penalties for late submission and penalties for late payment, and you could get both. So we're looking at the interest one at the moment, and the idea there is to broadly align the VAT treatment, bring the VAT system more in line with the direct tax treatment we have at the moment, where interest is charged by the Revenue from when you should have paid up to when you do pay, broadly speaking, which seems fine.
Sensible.
Yes, there are no particular problems with that. A few things to be thought about, like quarterly interest payments on account for corporation tax we were discussing earlier, which have different rules.
Yes, something I feel quite strongly about actually. Another one. But HMRC is saying in this consultation that quips work. You know, they've been in place, everyone understands them. So they're different. We'll just leave those as they are.
Well, I think, I mean, we met the Revenue to discuss this only yesterday, and I think the idea is to align the rules as far as possible, which is fine,
Yeah.
but not necessarily for the sake of alignment. So there are things like quarterly interest instalment payments that they might keep different, but they are seeking views on that.
Yeah. Well, I think
So it's not decided. Yeah.
to say, you know, this is a crystal ball game, and
Yeah.
companies don't have a crystal ball.
But so we can say that. No, I think they genuinely want to hear
Yeah.
that
Well,
sort of problem.
I think we should say it, because for large companies, it's 3 months or so, isn't it?
Yes.
It's come forward.
So that's come forward.
Yeah.
I think we do need to mention that.
Sure, we shall.
Okay.
And the other thing is the penalties for late payment, where at the moment for income tax, of course, after 30 days after the due date, 31st January in most cases, then you get the 5% late payment penalty, so the system goes. The plan is now the penalty would fall due immediately, as at 31st of January, you would be liable for it, but there would then be 30 days in which you could do something in order to mitigate the penalty. And
so would the penalty then drop away, or
well, if you do something within 15 days, either pay or agree time to pay, the penalty will go away.
Right.
15 days is an absolutely extraordinary period.
You may not know, presumably, at that point.
It involves the revenue noticing you haven't paid, doing a letter, sending it to you, you getting it, reading it, either paying or arranging time to pay, which is not necessarily done at the drop of a hat, or if you're a bit worried, seeking help and advice. Seems to me not really entirely doable within 15 days on the whole.
No, I don't think so either, and I imagine there'll be quite a lot of those sorts of letters going out, and HMRC historically has never flooded the post office,
Well,
and so
I
they
don't
stagger the dispatch.
I don't think it. Yes, I mean we not keen on that, because the penalty obviously is meant to be, or the threat of a penalty is meant to be an incentive for you to sort it out. And if there's really nothing you can do because there's no time, it doesn't work as an incentive.
Yeah, shoot me now.
If you do something between the 15 days and the 30 days, then your penalty will be halved, but you'll still get slapped with half the penalty at the end of 30 days, which baffles some people no end if they think they've paid.
Yes.
So it needs a bit of a think through, I think.
But it's not a very long consultation.
No, it's
so
mercifully short.
It's a quick read.
It's quick and easy read, and we'd be really keen to hear people's thoughts on that. It also includes getting rid of some of the stuff in VAT which is so different, like default surcharge and so on. And
yeah, well, I think that's a really good idea.
That's fine, again, provided there aren't reasons for keeping it separate. So alignment is fine, but this particular aspect of it is a bit of a concern, I think, as to whether it's realistic or does what it's set out to do.
So I think that one, actually Caroline Miskin is handling our response, isn't she? But people can still send their comments. If you want to send them into the taxpack@icaew.com address, that would be great. I think we should move on now back to Ian and his international front. Ian, you've been looking at the OECD's digital proposals, haven't you?
I have.
Proposals for taxing digital.
There are lots of proposals. The digital, I think 7 of the largest in terms of market capitalisation companies in the world are digital or digitally based. So they've all grown up in those ones which are very large. Even Google was only founded 19 years ago. Twitter 13 years ago, so
and
they've
they didn't make money for a long time.
Yeah, so they've all got a different business model, and although the OECD has been trying to say that you should be taxed, international businesses should be taxed where they carry out economic activity and where they make their profits, actually it's very difficult to determine that in the context of a digital company. So if you have Google with a digital platform, you don't know where your people accessing the platform come from, and you don't get money out of that transaction. You get money out of the advertising or the search results that then sort of are put 1, 2, 3 on your list.
It's easy to say.
So the money can
where the customer's based,
the
but
money can come from wherever it is, the advertiser. So it's very, very difficult to apply the existing rules to the digital world. So the OECD has been discussing this for 4 or 5 years in detail. So they produced a big long report in 2015. And that was when in fact they were supposed to
Well,
finish
that's
it
a
off
big
in
fat
2014.
book,
Yeah,
isn't it?
it was
That
about
was
400
it, yeah.
pages. So they,
That's
in
big.
theory, they were supposed to produce their report in 2014, and that would be it. Then they realised that it was all part and parcel of their general work, so they deferred it to 2015. And then they recognised that actually this world was changing all the time, and they kept the task force, digital economy task force, in operation. And they were going to produce a report at the end of this year, but then the G20 have told them to bring it forward. So they've now got to produce an interim report in April this year and the final report in 2020. And in the meantime, the European Union has been having a questionnaire and reports where we have to report
So
back
this
on
is
the
a
third.
completely separate.
But they're all on the same trail. So the
Mm.
European Commission had a deadline of 3rd of January, and the British government has got in the Act, and they've got a position paper on which we have to comment by the end of this current month about the digital economy and taxation.
This one.
So,
Yes.
and they've also produced a consultation document about withholding tax on royalties. So, how do you tax these people? Do you have some sort of turnover tax? Do you have some sort of impost, like a royalty payment when the money is flowing? Or do you have some other mechanism like diverted profits tax to ensure that people who organise their affairs such that what would otherwise be the profit in your jurisdiction turns up in a no tax or low tax jurisdiction? You have some mechanism to bring it back into your own jurisdiction. If everybody goes on their own sweet way and introduces unilateral rules, then companies potentially will be paying tax on the same profit several times.
Mm.
So it's not ideal. And we have all recognised, I think everybody's recognised, that the digital economy isn't something quite separate from the normal economy, but it does have certain characteristics which are peculiar to it and make it much more difficult for the existing rules to work as they currently do. So the work you did about 12 months ago about the reduction in the tax base is very relevant to the digital economy.
I'm
because
just ahead of time here.
yeah, no, we are. Well, that was in the context of the world of work, but the world of business and digital business means that the profit isn't identifiable by reference to a particular location, and you don't have any physical characteristics of the transaction or the activity. You don't have a factory somewhere where you can sort of say, well, there it is, that's making a lot of profit. We'll tax it where the factory is. It's just happening in the ether.
I know, and they do all have different models as well,
Yeah,
which I think
yeah.
it is valuable. Now you can read those articles that you mentioned that are still relevant today if you want some background to this in TAXline from
Yes.
last year.
Yeah.
But in the meantime, Ian, you are putting together the response. I know we're discussing
I've got
it
to do a
next
response
week.
to the British government's consultation. We've got an interim report in April from the OECD.
I mean, don't go it alone. There's got
But I
to
don't.
be.
Yeah, but I don't think. I don't think we'll see another version of that until it's in the public domain and presented to the G20, and then they'll have another 2 years to get on and do their final report.
Right.
And the European Commission will come up with some thoughts later probably in the first half of this year. So there will be lots of sort of ideas on the table.
So, but we're going to have lots of opportunity to comment on that one in the not too distant future.
Indeed, and
Okay.
there's a lot of money involved. So
A lot of money, and actually, it's really interesting.
No, it is. Yeah.
Yes.
Yeah.
It's,
Yeah.
So, commend corporate tax and the digital economy for this weekend's reading material.
Good.
Before we run out of time, Jane, can we just go back to you, please, for mandatory disclosure regime? This is another international.
Yeah, this is another area where everybody's jumping on a similar bandwagon, really. This is both the EU and the OECD are doing things about enforcing the common reporting standard. This is where financial institutions and others have to report details of account holders and so on. And which will then be shared between jurisdictions, and both the EU and the OECD have got different proposals about how to catch people who are not reporting cross-border transactions, or in the case of the OECD, offshore structures. Obviously the Panama Papers.
So weird structures we're looking
at. Structures that could be involving tax avoidance or which are opaque, where you don't know who the beneficiaries are, and the idea is that people would report those sorts of things, dodgy structures, how defined the past, don't know, to their own tax jurisdiction, and then that could be shared. The OECD can't insist that people do this, but it's going to produce recommendations about what could be done.
Right.
And they brought out a paper just before Christmas which hilariously has got a 15th January deadline for responses. I think not enough time to go into detail, but the main concern is that it's very broadly drafted and would require people to report perfectly legitimate structures that are there for good reasons, and could be, quite an onerous obligation on advisors such as our members.
So that's the OECD paper on reporting offshore structures. Okay, so that completes our list of international and disclosure roundups, but we've got a few things just to mention that are coming up by the tax faculty. We've got the NTD webinar next week, which I've already shamelessly plugged. That's 16th of January. We've also got Tax Club that is for younger members, so the under 35s don't have to be a member of the ICAEW or indeed the tax faculty, but it's people who are interested in tax, and that is 26th of February when Pete Miller is going to be talking about corporation tax, a practical overview of recent changes. You can find all of those details on the ICAEW.com website, and we have TAXtalk coming back on Valentine's Day, 14th of February, second Wednesday of the month as usual at 12:30. So hope you've enjoyed it. Please do get in touch if you've got any comments, and what we'd really like is your feedback, please, for 2018. Do you like this format? Any suggestions for improving things, shaking them up a bit? Ian, to do a song and dance routine maybe? Middle? But please let us know what you think, and hope you'll join us next time. Thank you for watching.